Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us today. Coming up on the show, Paul Harris, portfolio manager at Harris Douglas Asset Management, will be joining us for the hour. In 30 minutes, we'll get jobs reports from Canada and the U.S. Brendan Bernard, senior economist at Indeed, will help us break down those numbers and what they mean. And of course, we want to hear from you. First call is when we want to hear from you. Reach out with your questions on North American large cap stocks, and we'll have Paul answer as many of them as he can. That's at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes. And our email address, if you want to go that route, first call at bellmedia.ca. Now, here are some of the stories we're tracking for you in the BNN Bloomberg newsroom. Shares of Lululemon are trading sharply lower in the pre-market after the yoga wear maker cut its profit and sales forecast for the year. Lululemon says its performance is being affected by negative commentary in the media and online about its brand. It also says not all of its product launches have met expectations, and the now resolved proxy contest with founder Chip Wilson did not help. The manager of the S&P and Dow Jones indices has closed the door for tech companies like SpaceX to quickly enter the market with an IPO. The 12-month so-called seasoning period for newly public companies will not be shortened, nor will it waive existing profitability and public float requirements based on a company's size. SpaceX denial means that it won't be an immediate must-buy for index tracking funds. And now our top line story, and that is the shares of Lululemon. They are plunging in the pre-market after the retailer cut its full year forecast. Look at that, off by 11% right now. Cut its full year forecast, pointing to weaker performances in North America. The outlook fell below expectations as the company faces softer demand, stronger competition, and ongoing challenges ahead of incoming CEO Heidi O'Neill. For more on this, let's bring in our guest for the hour, Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, thanks as always for joining us.
My pleasure.
Friday to you. It's the weekend. Maybe not a good Friday, not a happy Friday for Lululemon.
Right.
They haven't got all their troubles behind them, have they?
No, I mean, I think that there's a couple of issues that they face, right? So more than a couple, but I think what the issue is, one is that they've had some products that have been poor that have come to the market. That's one thing, and they didn't meet expectations. The second is that they've kind of had this inventory issue, which they've got to kind of bring down, discount a lot of their stuff to get it out the door. Obviously they had a proxy fight, but also there was this issue that the present CEO was someone, Chip Wilson didn't like the present CEO.
He let us know as well.
Yeah, and doesn't come from kind of that kind of part of retail. She came from Nike. Yeah. So a very different sort of retail environment. And also I think the other thing is that, there's a lot more competition for Lululemon than there was years ago, right? They were very unique, or seen to be very unique products. Yes. Yep. Came to market, and they kind of had a hold on that whole yoga market area. And I think now you've seen a lot more competition come into them, and so they're fighting on many different levels. So I think what you want to see with the stock is probably not to buy it. Wait till the new CEO comes in. I would think that the new CEO will probably even kitchen sink this even more and sort of just, we're not going to meet our numbers all, basically.
Yeah, we're throwing it out the window to a degree.
And then maybe the stock has a chance to recuperate from there. But I think in this environment, there are just too many, variables that are going to hurt the company. And you have, the stock's fallen and they haven't even got the new CEO yet, who's probably going to, want to make this, kind of have a fresh start with everything. Yeah. Right, so I think that's one of the things you have to look for. But I think there is a general rule. It's not a company that we've owned, and I think retail is very difficult because of that. Right, so competition, inventory issues, constantly fighting all that stuff. Sometimes these kind of retail firms tend to overgrow by opening up way too many stores, and so they hurt themselves a lot. So, and I think that's part of what's happening with Lululemon as well. They're trying to bring down their space, their number of their retail stores, et cetera. So I think there's a lot of work to be done, and I think it's a work in progress. So I'm not sure, if you're going to see great returns very quickly in the stock.
Yeah. As a CEO, what would you focus on first? Would it be flawless product launches and new products, the inventory issue,
well, I think
quelling shareholders' fears.
Well, I mean, I think
where do you start?
Probably all of those things.
Yeah, just
but I think what you have to do is sort of clear out the old inventory. Bring in some new products, and hopefully have successful launches of those products, and maybe look at how you're pricing these products relative to the competition, right? So I think that there's a lot of things they have to do, but like I said, I think the stock will probably be, as a lot of people refer to it, dead money for a while, until you kind of get this opportunity if this new CEO can turn it around.
And Chip Wilson, he signed a deal that he can't talk about them disparagingly in private as well, not just publicly, but in private as well.
Right.
What was he saying in private that makes you wonder that they had to include that part? But do you think this will be enough to keep him quiet?
Well, I think he has
18 months.
Well, I think he's put a couple of people on the board. I think he has 2 or 3 people that he's allowed to put on the board. I think that'll probably makes a difference for him, because then he can obviously have some of his views expressed more clearly through the board members. But which shouldn't really happen. But anyways, but regardless, but I think
he can make suggestions to them, I guess.
Yeah. So I think that's going to make a difference for him at least. But I think that for him even, I think it's kind of work in progress, right? You just have to see if the CEO can actually turn the company around, if they can do, come out with better products, deal with competition, kind of bring the store count, the number of stores maybe down, but kind of, and how they kind of deal with bringing out new products. I think there's been a failure in that area for them.
And who is the competition for them? I mean, they kind of had a unique spot, but now they do have a lot. But are they still the high end of it?
I think so. I can't remember the actual names of the companies, but I think a lot of people can produce those products where, they were sort of came out with that, and nobody had those kind of products, right? So there are several competitors that I think that can easily produce a lot of the stuff that they produce, and in a similar fashion. So I think that's the part of the problem. There was nothing unique about their stuff in many ways, right?
Yeah.
So, and it catered to a certain audience who were higher end people that were able to pay for their products. And I think that you can see most of that kind of stuff now in a lot of lower end stores, and the qualities is equal, right? So I think that's the part of the problem that they face.
Yeah. All right. Well, we didn't solve all their problems in that chat there, but we've helped them a little bit, Paul. Thanks as always. Up next, the S&P Dow Jones is keeping strict rules for who gets into the S&P 500, shutting the door on fast entry for major tech IPOs. We'll get more on this after the break. Take a quick look and see how things are shaping up on the markets right now. We'll start with the U.S. futures, and you can see it looks like that weekly win streak that was at 9 isn't going to make it to 10. NASDAQ off by 1.2. S&P 500 off by a half point. Needs to be in the green for that weekly streak to continue. It would have been the longest for 40 years. Off to Asia now. And everybody is off today, and concerns about what's unfolding in the Middle East. Nikkei down by 1.3, the Hang Seng 1.15, and the CSI 300 off by nearly 1.8. To Europe now, and a little different attitude there. Green across the board. The FTSE 100 is up by 0.4, CAC 40 by 0.54, and the DAX up by about a quarter point. TSX yesterday, it finished up. It had a gangbuster day. Well into record territory again, floating around there, up by 1.2%. Some of the movers and shakers from yesterday. Curaleaf, the roller coaster, up by 7.2%. Bausch Health, almost 6%. Going the other way, Transcontinental and TransAlta. Transcontinental off by 9.77%. TransAlta off by 10.36%. Taking a look at the metals, and everybody's on a downward day. Gold below 4,500, off by 0.2. Silver down by 0.83% at 73.36, and copper off by 1.16 at 6.146. Taking a look at oil from yesterday, it dipped almost 3%. Western Canadian Select down to 76.79, and WTI today, let's see where it's at. It's up by a quarter point at 92.79. The S&P Dow Jones indices keeping strict entry rules for the S&P 500, refusing to fast-track newly public companies. That means big IPOs like SpaceX will have to wait at least a year, delaying billions in potential passive fund demand. For more, let's bring back Paul Harris from Harris Douglas Asset Management to get his thoughts on this one. Are you surprised that they stuck to their guns on this, or no?
Well, no, I'm not surprised. I mean, also, well, to be clear, the Russell is doing it, I think, and the Nasdaq 100 is doing it, is bringing those things in. So there, the S&P obviously is one of the biggest indexes in the world, and so that makes a big difference. I'm not surprised. I mean, I think these things should stick to. There are reasons why you do all this stuff, right? Because you want to understand pricing better. You want to understand like the liquidity. You want to look at what they call seasoning. So you get a couple of reports on earnings, so you can so investors can make better judgments about all this stuff. So there are reasons why they do this, and I do think they can stick to it. I think there was pressure from a lot of these from different investors to put it in there, maybe even people like Elon Musk, et cetera, right? But I think that, so it comes back to this issue about what's happening with IPOs. I mean, you're going to see $3 trillion IPOs, which is unheard of in the United States in the next little while. What's interesting about these things, and people tend to compare this to the tech boom of 2000, but it's very different, right? So, and I'm not trying to say that it's different this time around, but what is very different is that, some guy in his basement knowing to doing a web page could have brought a company IPO in 2000. That's not what's happening now. What's happening now is these companies have sort of matured in private hands for a long period of time. And so that's very, very different.
You have somewhat of a track record,
right?
Essentially.
And on top of that, a lot of the money that's been made has been in the private sector, not in the public sector. So you've got this long period of time where private individuals or pension plans, I think there was an article today in the Globe about teachers, actually owning these assets over a period of time, and then they're getting the fruits of that when they come public. But that's where the wealth has been accumulated. Mm-hmm. Hopefully wealth accumulates when they come to public investors. But that's a very different kind of IPO situation than it was previously, where people were just coming, because they could set up a website. They didn't make any money. They weren't, all these companies do make money. They don't make a lot of money, but they make money. So you can judge them very slightly differently. Whether their valuation at $1.7 trillion is fair is a very different story, but they do have a track record of doing all these things. And so they're very different things. So I think that's one thing that's very important about the existing IPO market. I think this issue about going into the indexes right away is very foolish. I think they do need to be seasoned, and investors have a chance. And also, passive investing has become such a massive part of the industry that if you put them into these passive indexes, ultimately their stocks would run up very quickly and cause a lot of problems, I think, for the market. So I think there's a reason why you don't do this, and I think it's a healthy reason. I think that's why why we have these rules in place, and I think it works well for investors to be able to see the companies. And who knows? I mean, that doesn't mean that they're all going to go up because they come public today, right? That's a lot of securities that are going to come to the market. Well, actually, it's not a lot of securities, but it's a lot of wealth that's coming to the market, and it has different impacts on other securities in the market, right? So,
how do you think Musk is going to? Because he's really tried to control. He's played hardball in how he's setting up this IPO. Do you think he'll be bothered by this, or will he try and fight it at all? Do you think?
Well, I don't think he can fight it because it's the S&P 500.
It's America.
So maybe he can, but I mean, I don't think that he has that ability to do that. But I think that he's probably, Roger, the reality is he becomes a trillionaire regardless of it. What happens if it goes into, he just becomes richer, right? So I'm not sure that makes much of a difference to him. I think what he has been able to do very effectively. And I think some of these big tech companies are very good at this. They've been able to, really control the environment with the brokerage firms that are bringing them public, and how they want to run it, and setting a price. Usually there's a range. There's no range. It's $135. That's it. So I think that he has a lot of power because of the value of the IPO.
Yep.
How it's the companies that are bringing it public are getting really it sets a status symbol for Goldman and secondarily Morgan Stanley. So I think it makes a big difference. And so I think because of the size of it, he has more control. If it was a smaller IPO, they wouldn't have as many controls. And I think the brokerage firms like Goldman also would have control of the power. So I think, so it's much more of a balanced, or maybe even more powerful on his side. And I think that's the exact same thing with ChatGPT and Anthropic. They are very powerful because of the size of their IPOs.
Yes. Right. Now, what is there a benefit to NASDAQ doing what they're doing by waiving?
I'm not sure. I mean, I think that, I think it's just bad.
Or could it hurt them?
Well, I think it's just bad as a general rule. Like it hurts retail investors. That's who it really hurts. Mm-hmm. Right? And I think that, they're doing it because obviously people will buy funds tracking their index, right? So and it creates a lot of volume. But I think it's a bad thing as a general rule. I think there are reasons why we do all this stuff, and they've been put in place over years of watching IPOs come to market. And it's really unfair to other IPOs, right, who don't get included in the X, obviously, because they're just smaller.
Yeah.
And that argument. So, and I don't mean smaller by, a couple hundred millions. They may be $4 or $5 billion or $10 billion companies that came public, but they're just not included until the thing. So I think if you want to level the playing field, this is the best way to do it, right? And I don't think the NASDAQ or the Russell is doing anybody any favors.
Okay, we're going to take a break on that note there, but up next, we'll be back with Paul to see why Alphabet is on his radar. Time to see what's on the radar for Paul Harris, portfolio manager at Harris Douglas Asset Management, and Alphabet is pinging right now. Alphabet, why?
Well, there's a lot of things I like about Alphabet, right? So one, I think that search continues to do very, very well for them. People thought it would disappear because of ChatGPT, but people use search in a very different way with Alphabet, so that continues to do well. I think that you've got YouTube, which is, I think, the second biggest competitor to Netflix, even though there's other streaming services. So I think it continues to grow. It continues to grow, build advertising growth through them, and more things are on YouTube. I think that the third thing was that I think people felt that at the beginning of last year that they had lost the AI kind of battle, and the stock was trading at 18 times earnings, and the market was at 22, and nobody wanted to own it. And I think that they show that they're one of the leaders in AI. They always have been, and they were able to come out with Gemini, and so I think they're on a very different track now with that. The other business that they obviously own is the cloud computing business, and I think that you saw very good growth in that in the last quarter, and that will continue to accelerate, I think. So you've got sort of four businesses all chugging along very, very well. And I think the last thing is that you have Waymo, which I think is a self-driving car business, and they're way ahead of any competitor, Tesla, anybody on that. They are in so many different cities. I think this is going to become ubiquitous over the next several years. There's no reason why, you shouldn't get into a Waymo as opposed to an Uber. It's very simple. My daughter used it in San Francisco. She says it's the greatest thing in the world. She said, it's just so easy to use. And it's disconcerting when you first get in, but after that you get used to it, and it's not. So I think it's so I think there's a lot of things that they're hitting the ball out of the park on, in my view at least. And I think that's why you want to own the stock. Digital advertising will continue to grow where it is, and I think that AI is going to be very, very powerful throughout many, many areas, and they're in the kind of central part of all that.
Could they be heard if Google search, essentially people stop Googling things, where you come up with a new word? Would they be all right? I mean, can you see them with everything else that they have going?
Yeah, so the problem I think is people still use, if you want some more intense things done, you'll talk to ChatGPT, or you're writing an email or something like that. You will do that through ChatGPT, maybe, or if you're trying to research something in a bigger way, like, oh, I want to look at, not that you can't use Gemini for it, but let's say use, I want to understand Alphabet stock or something like that. Mm-hmm. But if you're looking for the restaurant around the corner or something like that, there's no reason to go to ChatGPT, right? It's just so easy, and it's on your phone, and it's so much easier to go and say, oh, what's the closest pizza place close to me, or something like that, right? So I think, like, from that perspective, that aspect, or if you're a plumbing company or this company or that company, you're just going to use Google. It's just so much easier, right? So I think that kind of part of it is not going away. Yeah, you may see little less use of it, but it's certainly not going away at a level that people think, right? So I think that there's you've got to be, at the margin you may lose some of that stuff, and people may move to ChatGPT, but I think they use those kind of Anthropic and those things in a very different way. Right.
All right, MSCI.
Right. So MSCI is a indexing business. They have MSCI World and stuff like that. The beauty of these businesses, it's an oligopoly, or technically there's only 3 competitors: the FTSE, the S&P 500, and MSCI. MSCI creates not only indexes to which people benchmark against, and why that's really important is that, as a portfolio manager, you can't go create your own benchmark. It would be so you have to use that. But what comes with that is a huge level of analytics, right? How do you the risk of your portfolio, managing your portfolio? If you have a tracking index, like an index fund, you have to use one of these products from MSCI. They've also moved into private markets like real estate, private loan businesses and all that stuff. So they've got an array of products. They are sort of well diversified around the world on these kind of indexes. And anybody, like, for example, BlackRock or some of that uses them has to give them some percentage of when they use them. So it's a great business, lots of great free cash flow, a great gross margin business. So I like it because I think that business will continue to grow. And even if the asset management business shrinks by the number of people, that's the big issue for them. When they merge, you lose a client necessarily. Mm-hmm. But the analytics parts is very, very important because it becomes riskier and riskier with portfolios. Exactly what we talked about earlier on. If SpaceX goes into index, how does it affect everything? Yep. How does it manage it around? So I think those kind of things are really important when you're a big player in managing money, to understand the index and understand the analytics around it and the risk profile of your portfolios. Right?
All right. Want to sneak in one more? Microsoft.
Yeah, so Microsoft's had a hard time over the last little while. I think people think that everybody's going to rip out Office and all the stuff and just use Cloud to design your own products. But Microsoft is a very integrated product on that side. That's one thing. And they have a very large market share. Yes, they may lose some seats. That's one thing. The other thing is that they are in the midst of being one of the hyperscalers on AI, and they've got a lot of their own AI products. So I think that people are underestimating the value that Microsoft brings. The other thing is that Microsoft deals with so many enterprise companies, right? Huge businesses that use Microsoft daily in all their products, like the banks in this country and stuff like that. So they're not ripping all those things out, and most likely they'll feel safer going to a product in Microsoft, like a Copilot, et cetera, right? All
right, we got to wrap it up there, Paul. We've got some breaking news coming up. Still ahead, Canada and the U.S. will release its latest employment data. We'll have those numbers and break them down with our next guest, Brendan Bernard. And our phone line's open, 1-855-326-6266. And you can send us an email, firstcall@bellmedia.ca. All right, we have some breaking news for you now. Stats Canada has just released the latest employment numbers in the U.S. as well, doing the same. Just quickly, we're going to give you a couple of the numbers here. The unemployment rate, 6.6%. The survey had it at 6.9%, so that's quite the change. 154,000 full-time jobs created, and a drop in part-time jobs by 66,000. South of the border, the unemployment rate unchanged, 4.3%, 172,000 jobs created down there. So let's bring in Brendan Bernard, a senior economist at Indeed. Brendan, always a pleasure to have you here. Looking at these numbers, I think the Canada 6.6, well below what people were expecting.
Yeah, this is the first solid report we've seen in a few months. We started the year down 3 out of the first 4 months, and in May, a really nice beat. 88,000 overall increase, unemployment rate dropping. I'm seeing widespread job growth across most industries. That's good news. It doesn't change the broad trajectory of the job market, but after a slow start to the year, it's a relief.
Hi, Brendan. It's Paul Harris speaking.
First time caller, long time viewer.
So I'm just curious. So one of the things I think people have noticed with unemployment numbers, and one is, obviously looking at one month is not relevant. It's a broad thing that you talked about. But are you seeing in those numbers that people are, not like hiring as much in certain areas because of AI, or, it seems to me that people are able to do as much with less people. And so maybe they're not firing people, but they're not hiring anymore. Do you see those in the numbers in any way or form?
So I think there are two parts to the question. On the hiring side, the subdued labor market over the past few years is because of slow hiring. So that part is true. Whether it's part of AI, though, I'm not sure. If you look at our productivity numbers, for instance, you don't see much of a sign of AI in there. GDP growth in white-collar industries like professional services, it's not growing very quickly. So if we were getting this like major productivity boost from AI, that would both potentially show up in hiring, but also in actually stronger output growth. And as we saw with our Q1 GDP numbers, we're not seeing that strong growth. And also hiring has been subdued across most of the economy. And so I think in general, the sort of subdued labor market conditions that have been persisting the past few years, I think it's more to do with sort of cyclical and structural problems in the Canadian economy rather than how the labor market's reacting to this new technological era.
And is this a seasonal thing, or is this we've been a lot of no hire, no fire? Are companies finally going, you know what, we got to start hiring some people?
That would be nice to see, and we'll have some time to dig into these numbers in more detail to see if there's been a meaningful shift. But I wouldn't react too much. We've got a nice 88,000 print here, led by full-time jobs, but that is basically reversing of all the weak numbers, a lot of the weak numbers that we saw earlier this year. So we're kind of like on net back where we started. And so I think it's going to take more sustained progress to really get back into a situation where job seekers are more in the driver's seat. And that is going to require just a stronger, broader economy than we've seen in recent months.
Hi, Brendan. It's Paul again. So I'm just wondering, do you think this changes the view of the central banks in Canada, the United States, given these numbers, or do you think they are kind of dealing with this issue that's, Iran and oil prices and maybe possibly inflation, what's your view about where you think rates are going to go over the next little while?
So I think the Bank of Canada has been looking through a lot of the volatility in the job numbers over the past few months, where this is probably more the same. But my initial reaction, relief, I think the Bank of Canada is probably thinking the same thing here, that the unemployment rate is not on an upward trajectory, even though it was rising a bit at the start of the year. That's sort of reversed, and we're kind of where we've been over the past year or so, this in between 6.5% and 7%. This is kind of it's not a great job market, but it's also one that's not actively deteriorating. And that means the Bank of Canada can focus on its main mandate, which is inflation. And there, I think if there's signs of the inflation world are at least stable, energy prices notwithstanding, well, then I think the bank is probably will be thinking hold pat and just wait for more information. And this is different than if we had a continuation of those weak job numbers that that started the year, if the unemployment rate was trending past 7%, that would be raising alarm bells and potentially causing a policy shift.
And how do these numbers play in with the two? We have 2 quarters, 2 negative quarters, although the CD Housing don't go with the recession yet. How does this play in these numbers? Does that reinforce that this isn't a recession?
So I think the first quarter of this year, it was a rounding error, and it could easily be revised. The economy is subdued and over like a longer period stagnant, but it's not actually really contracting. If you plot out GDP on a line, it looks pretty flat over the past year. And I think these numbers are broadly part of that story. When taking the labor force survey from where it started this year, things are relatively flat, especially once we factor in the slow pace of population growth after years of rapid population growth. And so without like getting too ahead of ourselves with this one positive number, I think it's more consistent with just sort of stable conditions in the job market, probably stable conditions in the overall economy, but still, I think one where, we're the engine there to like drive a sustained improvement in labor market conditions after deteriorating, that I don't know if we're there yet.
All right, Brendan, we got to wrap it up there, but always a pleasure talking to you. Thank you, sir.
Thanks for having me.
Brendan Bernard, senior economist at Indeed. Shares of Lululemon are trading sharply lower in the pre-market after the yoga wear maker cut its profit and sales forecast for the year. It's up by more than 10%. Lululemon says its performance is being affected by negative commentary in the media and online about its brand. It also acknowledged not all of its product launches have met expectations. And the now resolved proxy contest with founder Chip Wilson did not help. The manager of the S&P and Dow Jones indices has closed the door for tech companies like SpaceX to quickly enter the market after their IPO. The 12-month so-called seasoning period for newly public companies will not be shortened, nor will it waive existing profitability and public float requirements based on a company's size. SpaceX denial means that it won't be an immediate must-buy for index tracking funds. Donald Trump says the U.S. will spend hundreds of millions of dollars to revitalize the country's coal industry. That money is to build new power plants, sustain existing operations, and construct an export terminal in California. Trump says the move will bring down the price of energy and the cost of living for all Americans with the power of what he calls clean, beautiful coal. He cites China as an example of a coal producer. Still ahead, today's market drivers with Bloomberg's Janine Panzer. And of course, our phone lines are open. Paul Harris is taking your questions on North American large cap stocks. Reach out at 1-855-326-6266. You can email us. First call at bellmedia.ca. Time for a look at some early market movers, and for that we're joined by Bloomberg's Janine Panzer. Janine, thanks as always for joining us. Let's get right to it. Samsara, what's going on there?
Yeah, Samsara is down about 2.5% in pre-market trading. This despite reporting the earning result that beat estimates. So the fleet tracking company posted 30% in revenue growth and raised both its revenue and profit forecast for 2027. So analysts were broadly positive. KeyBank highlight continued momentum with large customer and multi-product adoption, while TD call it actually another strong beat and raise quarter. Still, what happened? The stock had gained roughly 20% actually heading into the report. So today weakness, analysts are saying it may reflect some profit taking in the wake of that recent strength. Roger.
All right, and Merlin, their shares are soaring right now on their the autonomy on large aircraft. That's what they're working on right now, like C-130s. Holy cow!
Yes, the the aerospace and defense tech company shares are up this morning. Last I checked, with about 27%, and
It's actually up over 30 now.
Up over 30 now.
Yeah,
wonderful. The company has actually completed the critical design review for its C-130J autonomy program with the U.S. Special Operation Command. This is a key milestone that validates the system design before testing begins. The program will now move into a structured test campaign, including aircraft level testing, and as it advances from design through verification. CEO Matt George actually says that autonomous flight from takeoff to touchdown has the potential to improve operation and safety for U.S. warfighters, Rogers.
All right, and DocuSign, not on the bottom line right now.
DocuSign is down about 4% in pre-market after issuing a 2Q result that the revenue forecast that came in roughly in line with expectation. The firm actually delivered a solid quarter, beating estimate on revenues, earnings, and free cash flow while modestly raising its full-year outlook. But analysts are saying that the broader debate around the stock hasn't changed at all. Morgan Stanley says financial improvement remains limited, and RBC says it is in wait-and-see mode on that DocuSign AI-powered contract platform, the Intelligent Agreement Management. So we'll have to see about that. As of the last close, the stock has fallen about 26% this year.
All right, we'll wrap it up there, Janine. But thanks as always for joining us. Have yourself a great weekend. Bloomberg's Janine Panzer. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a downgrade on tech resources. All right, let's take a look at some of the notable analyst calls and recommendations. Veritas downgrading tech resources to reduce from buy with a price target of $100 Canadian. This is now the only sell rating on the stock. Goldman Sachs analysts downgrading Suncor to neutral from buy, $72 price target US. The downgrade reflects valuation as the company's successful operational turnaround is now better captured in its share price. Well, Goldman sees less relative upside and maintains a positive outlook on Suncor. And Chipotle shares are rising in the pre-market after JP Morgan upgraded the stock to overweight, calling it a rare valuation opportunity. The bank said the valuation now reflects slower but still above average growth. It expects the stock to trade at a lower price level compared to its earnings. JP Morgan set a $35 price target, implying about a 24% upside from the last close. Now, for more on this, let's bring in Paul Harris, get his thoughts on that. We'll start with Suncor.
So we own Suncor and we own CNQ in our. But I think the issue for these oil companies. I mean, I think the comment is perfectly right. I mean, Suncor was going through some very difficult times. Mm-hmm. They've kind of sorted that out. I think that makes a big difference. I think that what's obviously driven the stocks over the last little while is what's happening with oil in Iran, and I think those things creates this kind of volatility in the stock. So I think that what you have to see is that if you see it really a big day in oil and these things run up, I would say you probably want to reduce your position in them if it's a substantial position. And if oil, because I think that if we get through this period, oil will go back naturally over a period of time to something more stable. And I think these stocks are representing a much higher oil price than maybe can really exist. So I think that's what you have to do with these stocks. But they're good companies. I think they're the best companies in Canada when it comes to oil. And I think that they are both CNQ and Suncor have been astute at a couple of things. When they've seen oil at very low levels and they've been able to buy companies at great valuations. So I think they're good at acquisition and they're good at when they work on projects, especially CNQ gets them done right on time. So I think you've got two really great businesses in Canada. I know sometimes people want to go buy oil somewhere else. I always feel that we've got this great industry in this country, and you should be buying Canadian oil companies.
Okay. And Chipotle. It's an industry it's a tough industry, isn't it?
Right. So you're chuckling
At the overweight.
at the overweight thing. So,
Right. Kids sometimes, and it's Friday.
So I mean, it's not a company that we own, and I don't really like those kind of businesses. And I think that you kind of go through these periods of time where they're very popular and they do incredibly well, and then you have a lot of disarray because they grow too quickly and stuff like that, because they open up too many stores, et cetera. So I don't particularly like these businesses. I think the fast food industry is going to have a lot of trouble because people are really looking at what they eat more and more.
And price too. Price is an issue, even for the cheaper end.
Yeah. So, and it's not cheap to buy. Like, if you go to lunch, I'm not sure what it costs at Chipotle, but it's probably costing you between $12 and $18 to get a lunch, right? Which is a lot of money. And so, I think that. So I think those are the issues that they face. But Chipotle sort of brands themselves as slightly different, more natural, all those other things. But in the end, it's still a fast food business, right?
Yeah.
And so I think that it's not healthy for you. You should bring your lunch like I do every day.
All right. Thanks, Dad. When we come back, Paul Harris takes your questions on First Call. All right, time for First Call and first email. It's from Dorma. And Dorma says, I'd like a comparison of JP Morgan and Morgan Stanley. Which would be the best choice for investment?
Right, so we own JP Morgan. We've owned it for a long time. So, they're slightly different organizations. JP Morgan, although has a large investment banking business, is a retail bank. It's an investment bank. It's a credit card company, all those other things, which makes it very different from a funding point of view. Morgan Stanley effectively is a bank, but they don't have that kind of growth, retail businesses. But they do have a huge asset management business, a huge brokerage business, and obviously the investment bank. So you have to think about them as slightly different businesses. Mm-hmm. I think that in a world of the upside comes from Morgan Stanley when we go through these periods of time where you see this huge IPO business, M&A business, and all that stuff, because that's kind of the core business, and the ROE is much higher on that stuff. Whereas I think JP Morgan, in a much more difficult time, has a much better balance sheet, has much more other stable businesses like retail and stuff like that for funding purposes. And I think I think that in this environment, you probably want to own JP Morgan. Morgan Stanley, yep. But in a much more calmer environment, JP Morgan makes more sense because it's much more diversified from a company point of view in the financial services.
All right, let's get some more emails in here. This one's from Mike. I'd like your guest's view on Brookfield Corp.
Yeah, so we own Brookfield Corp. We've owned it for a long time. I like the company. You can own, Brookfield has several subsidiaries, but Brookfield Corp owns most of those subsidiaries. So one of the things I like about Brookfield is that they are, they're able to do deals very, very well, even in a competitive market that they find they're in nowadays. And they're able to raise a lot of money. And so what they've been very good at is when you've seen very difficult times, they're able to go in and buy assets really cheap. And I think that's very important. I think that the second part of it is that for Brookfield is that in environments like this where the market's really strong, they can exit assets that they don't see any time to
the flexibility.
Yeah, and because of their balance sheet and because of their long-term approach, they can buy assets which some people would feel are not stranded as much, but not having a good time. But they get them cheap, then they can kind of wait till they see the opportunity to exit them or to grow those assets. So it's a great company. I've owned it for a long time. You can own Brookfield Asset Management or the other aspects of it, but I like owning Brookfield Corp. But I think that it's a unique business in this country, and they've got some really bright people that work for them. I think you should buy it and hold it for a long period of time.
All right. This email is from Chris. What's your take on the gold market going forward?
Yeah, so gold has been a tough call because I've not owned gold stocks in our portfolios. I don't particularly think gold companies are great businesses. But I guess what I would say is if you really like gold, I would buy the gold future or a gold index fund. Mm-hmm. I think it's better for you to do that than to buy the underlying companies. I don't think they're great businesses naturally. People say they're they're great businesses in a period of time, which is just the period of time, right? But they're not environmentally friendly. They've got other issues, and oil being up like this, expensive like this, is a lot of cost for them because gold being high is fine, but they run a lot of their business depending on where they are with a lot of oil and stuff like that. So that's expensive for them. So I think that their cost structure is going up, but I think that if you really like gold at these levels, I think you buy a gold ETF.
All right. Next email. It's from Al and says, is Micron a buy now?
Well, I guess if you're a momentum player, you would buy right now. I mean, I think the issue is that, so one of the things is that memories and that DRAM stuff, it's a commodity. It really is, right? Yep. And it always has been. And so you get oversupply, massive oversupply of the stuff and everything, and the prices collapse on the stuff. So this is going through a period where people say, it's different this time because of AI. It probably isn't, right? It probably has gone up because there's a shortage of supply. They can supply it and they'll be able to raise prices, and that's great. But at some point in time, you get an oversupply of this kind of chip business, and they collapse in price. And so I don't if you're a momentum player, you may want to buy it at these levels. You're probably better off buying the SOX index, which is a semiconductor index, which is better for you to buy as opposed to buying the stock because it's run up so much. Right. But just remember, they're cyclical.
All right. I got to wrap it up there. Okay. We're almost out of time, but Paul, always a pleasure. Thank you for joining us today. That is it for us here on The Street. Again, thanks to Paul Harris, Portfolio Manager at Harris Douglas Asset Management, for joining us today. Lindsay with the Opens Up next. Trading gets underway 30 minutes from now. Have a great day and a great weekend.